Okay, this is going to be part 2 of the chapter 2 problems. We're going to pick up with exercise 2-12. That's exercise 12. And then continuing with our ratio analysis. And we're looking at a company 2022 versus 2021. And we left off with the earnings per shares calculation, where the EPS, as I previously calculated, was 87 cents a share per share, earnings per share, and $1.85 over here in 2021. So clearly you have a downward trend here. The company is not doing as well. So item C is asking for your debt to assets, where you're going to take your total liabilities and you're going to divide it by your total assets. So in 2022 you had 554 645 divided by 1963 676, 28.2%. assets to, liabilities to total assets was 28.2%. But in 2021 it was 527 216 divided by 1867680, and this was also 28.2%. So it's the same. There's no change there. It's not getting worse, it's not getting better. Item D is asking for free cash flow, and free cash flow, as you remember, is cash flow from operations minus capital expenditures minus dividends. And in 2022 we had 302,193 minus 265, and capital expenditures 335 minus the dividends of 82,394, and this is a negative 45,536. Not good number, negative free cash flow. 2021 cash flow from operations 464,270, capital expenditures 250,407, and dividends paid 80,796. Free cash flow was 133,067. Positive number, but again you can see downward trend here. So the company is not performing that well. So we looked at all three ratios. We saw where the debt ratio, where the current ratio went from 2.7 down to 2.3. We saw where the earnings per share went from 185 to 87 cents. And then the debt ratio stayed the same. Free cash flow did not improve. So generally speaking, this company is not doing as well as it did in the previous year. Let's move on to the next problem. And the next problem is exercise number 14. And exercise 14 is walking through some matching concepts, trying to understand, this is number 13, Number 13's presented below are the assumptions and principles discussed in this chapter. Full disclosure, going concern, monetary unit assumption, periodicity assumption, historical cost principle, and economic entity assumption. So item A, belief that a company will remain in business for the foreseeable future. That's number 2, the going concern assumption. Item B indicates that personal and business record keeping should be separately maintained. Separate the shareholder from the corporation. That's number 6, economic entity assumption. Item C, only those things that can be expressed in money are included in the accounting principles. That's item 3, the monetary unit assumption. Item D separates financial information into time periods for reporting purposes. 1 month, 1 quarter, 6 months. That's going to be the periodicity assumption. Item E, measurement basis used when a reliable estimate of fair value is not available. So item 5, the historical cost principle. And we're going to find later in the chapter where assets need to be stated at the lower of cost or market. Lower of cost or market. And then item F dictates that companies should disclose all circumstances and events that make a difference to financial statement users. That is the full disclosure principle. So that's item 13. Let's look at item 14. And item 14 lists a whole bunch. It says the following list of terms or phrases are discussed in this chapter. And we need to match them up. Item A, whether an item is large enough to likely influence the decision of investor or creditor. That's materiality. Item B, constraint that weighs the cost that companies will incur to provide the information against the benefit that financial statement users will gain from having the financial information. It's the cost constraint, also known as the cost-benefit relationship. Item C, obligations that a company expects to pay within the next year or operating cycle, whichever is longer, expects to pay. That's current liabilities. Item D, information that is complete, neutral, and free from error, faithful representation. Item E, the primary accounting standard setting body in the United States, FASB, Financial Accounting Standards Board. Item F, net cash provided by operating activities after adjusting for capital expenditures and cash dividends. We just saw a problem like that, free cash flow. Item G, a set of accounting standards that has substantial authoritative support and which guide accounting professionals. GAAP, GAAP, generally accepted accounting principles. Item H, the ability of a company to pay obligations that are expected to become due within the next year or operating cycle. That's liquidity. Item I, the average time required to purchase inventory, sell it on account, and then collect cash from customers. That is to go from cash to cash. It's the operating cycle. Item J, the quality of information that indicates the information makes a difference in a decision. It's relevance, whether something is relevant. The agency of the U.S. government that oversees U.S. financial markets and accounting standard setting bodies, Securities Exchange Commission, SEC. Item L, the quality of information that occurs when independent observers using the same methods obtain similar results, verifiable. Item M, the difference between the amounts of current assets and current liabilities, that's working capital. And item N, the ability of a company to pay interest as it comes due and to repay the balance of debt due at its maturity. That is solvency. So that was item 14. Let's look at problem 3A. And in 3A, what they're asking here, that's problem. No, we're looking at another instead. Yep, let's look at problem 3A. And in this problem, what they're asking is that you're provided with the following information for Lazarus, and it is a bunch of accounts in alphabetical order. And what they want you to do is prepare an income statement, statement of retained earnings, and a balance sheet. So you essentially need to know where things go. So you would use a title here, you'd call it Lazarus Enterprises Income Statement for the year ended April 30th, and you would start with sales revenue, which is $5,100. And then you have your expenses. Cost of goods sold, $1,060. You have your salaries, expense, $700. Interest, expense at $400. Depreciation, expense, $335. Insurance, expense, $210. Income tax expense, $165. Total expenses, $2,870. net income 2230. And you know you're going to need that for the statement of retained earnings. And they told you that retained earnings beginning was $1,600. You're going to add net income, which is that number right there, 2230. You're going to subtract dividends of 325, and you have retained earnings ending of 3505. And you know that that number right here is eventually going to the balance sheet. We'll need to remember that. We go on, they're asking you to do for Lazarus to prepare a balance sheet. And we're interested in current assets, which we know are cash at 1270. Assets are listed in the order of liquidity. Stock investments, which they say are short-term, 1200. Accounts receivable, 810. Inventory, 967. And prepaid insurance, $60. Total current assets, 4307. Now we talk some of our long-term assets, and we have investment in land. It's clearly identified as an investment, $14,200. We have our property, plant, and equipment for land of $3,100. We have equipment of $2,420. And we have accumulated depreciation, which is a contra asset account. It's a negative 670. And we have our goodwill, sorry we're running out of room, of $1,800. You have total assets 25,157. Total assets 25,157. And you know that's going to have to balance with our liabilities and owner's equity. Let's take a look at the liabilities and the owner's equity. We have our current liabilities. I always like to list accounts payable first, $834. Notes payable, $61. We have some salaries payable. Don't confuse it with the expense, of $222. Taxes payable, $135. Current liabilities, $1252. Long-term items, we have a mortgage of $3,500. We have total liabilities of $4752. Stockholders' equity, we have common stock of $16,900. And retained earnings, which we calculated on the previous schedule, $3,505. Total stockholders' equity and liabilities at $25,157. They should balance out. So there you go. That's it for the second half of the problems. Thank you.